The American Association for Long-Term Care Insurance produced a report that found that 50% of Americans will need over $250,000 for long-term care expenses in their lifetime. Now keep in mind, that's per person and in today's dollars. And long-term care expenses have increased significantly faster than the standard cost of living. Today, I'm gonna be breaking down the smartest ways to pay for long-term care expenses so you don't end up draining your life savings. I'm Matt Franchina, the People's Advisor. For the last 16 years, I've been simplifying complex planning, helping you protect your health, build your wealth, and secure your legacy. Let's get into it. So if you haven't seen them yet, we have two other videos on long-term care planning. The first one talks about what is long-term care in general and who ends up needing it. Second video, I'm getting into the types of care and what these different types of care cost. So a quick recap on the cost, it could range anywhere from a couple of grand all the way up to $10,000 to $15,000 per month, depending on the type of care you're getting, where you're at, and what amenities might be included in that. Without a plan, these costs can completely wipe out your life savings in just a matter of a few years. So how are people supposed to pay for this? 70% of Americans mistakenly think that Medicare will pay for long-term care expenses indefinitely. Well, that's not true. Medicare does not pay for long-term care expenses. Medicare pays for medical expenses, things that include skilled nursing care up to 100 days max, physical therapy, occupational and speech therapy, and Medicare also pays for hospice for patients who are deemed terminally ill. What Medicare does not cover is long-term custodial care, things like bathing, dressing, eating, cooking, etc., assisted living facilities, and nursing facilities. Now, I want to note, earlier I mentioned that it does cover skilled nursing facilities up to 100 days. The way Medicare works is that every beneficiary is eligible for up to 100 consecutive days per admittance, but those days are only awarded if you can achieve milestone-based progress that meets up with your plan of care, like get out of the bed today, walk to the end of the room, down the hallway, etc. If you cannot comply with the plan of care, they're going to deem it as chronic, and the cost coverage for your caregiving will stop at that point. Medicaid. So Medicaid is a program that's a joint venture between the federal government and the states. In California, they call it Medi-Cal, but these programs will pay for long-term care, except they'll only pay in a nursing home that's approved by the state you're residing in. Now, there are some strict rules around this. In many states, it works under the standard Medicaid rules, which is going to have income limits, and it's going to say that your total assets cannot be more than $2,000 for a single individual. In California, they recently removed the asset limit, so they don't look at how much assets you have, they just look at what your income is versus the cost of the care you're getting to determine if they will pay for your nursing care. Quick note, there is something called the Estate Recovery Program in California, where any of the assets that are left to probate could be recovered for whatever they had paid for your care over the years. In all my years of doing this, I've had very few people tell me that their number one pick for where they're going to receive their nursing care is going to be in a Medi-Cal or Medicaid nursing home. Statistics tell us that 60% of all nursing home expenses are paid for by Medicaid. So what does that tell us? A lot of people ran completely out of money to qualify for Medi-Cal. So planning ahead is important so you don't end up in a position where you've spent everything and now you're relying on the state or federal government to take care of you. In my experience over the years, insurance has been the greatest unlock to people being able to maintain their lifestyle while they age and still need care. So there's three main categories of insurance. The first is going to be your traditional long-term care insurance. It's been around the longest and it works a lot like health insurance. Your second are the hybrid products. Hybrid long-term care products are a combination of life insurance and long-term care insurance built into one. And the third would be annuities with long-term care benefits. These are great products, especially for those of you self-insurers that feel like you don't want to buy insurance. Well, here's a great way to supercharge your money and put it to work in ways that it would never do all on its own. Traditional long-term care insurance is kind of like health insurance or auto insurance. You pay to be protected, you live through your life hoping you're never going to need it, and if you don't really get anything out of it. If you have a bad taste in your mouth from long-term care insurance, it's probably because either you had one of these policies or you know someone who had a bad experience with it. The two most common situations that take place are: one, premiums have increased over and over and over again, causing these plans to be unaffordable and people having to cancel them or significantly reduce their benefits. Or people thinking that their parents are going to have all of this care paid for, finding out later that what they bought was only to pay in a nursing home or some specific situation, and the care they needed didn't qualify, causing the insurance to not pay out at all. But the industry has answered. There are products that solve all of these problems, and they're called the hybrid products. Hybrid products are kind of like permanent life insurance and long-term care insurance had a baby. It brings the best of both worlds together. It pays a tax-free death benefit on any of the money that's not used. So it's no longer a use it or lose it situation. And on some of them, depending which one you buy, the premiums can never change on you. And for those that the premium can change, it's a lot more predictable and it will never go up the way the health insurance ones did. And the last insurance category for today, annuities with long-term care benefits. It is said by LIMRA that annuity products with long-term care benefits have increased over 40% in the last 5 years. And this gaining popularity is because of two main situations. One is there are a lot of people who look into this insurance and they're at a stage in life when they're feeling the aches and pains and health is a concern, and they can't get your hybrid products because those need full medical underwriting. So if that's the case, annuity products tend to have very limited or zero medical underwriting at all, allowing you to put your funds in a position to enhance when long-term care is a need later down the road. Or the other situation is that some of you self-insurers who really would rather just use your own money to take care of these expenses, this is a way to supercharge that money. You can put it into an account, it's completely safe from any market risk, it's designed to earn enough to keep up with those rising costs, and then if you need care, money's there and available to pay for it. If you don't need care or you need to use it for something else, it's accessible and it's still completely your money. So if you're watching this and you're thinking, I'm too young for this, I could plan for it later, just remember that age-old saying, no one's getting younger, nobody's getting healthier, and nothing's getting cheaper. I might be the first advisor to tell you, not everybody needs insurance, but nobody should go without a plan. So if you want to learn more about this stuff, make sure you're subscribed to our channel. We've got 2 videos we've already released, 1 more coming out, and there's a guide linked up in the description below. Again, I'm Matt Franchina, the People's Advisor. Look forward to seeing you again soon.